You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome to the Infinite Banking Mastery Podcast. Thank you so much for being here. I appreciate you. Today, I wanted to talk about what happens when dividends are earned. Dividends are something that you receive inside of your whole life contract, and they are based on a company's financial performance and their profits. So you have the guaranteed crediting rate, and then you have the dividends that the company pays based on their financial performance and profits. And these dividends are only paid on whole life policies. So universal life, variable universal life, variable life, term life, none of those policy types come with a dividend, only whole life insurance. And so these policyholders, once you receive your dividend, you can choose what you want to do with your dividend. You can either receive the dividend just as cash, like you could ask them, just send me a check. I'm good with that. I just want you to send me the money. And they can. They'll just send you a check if you want to receive your dividend that way. You also have the option of applying them to future premiums. So the dividend in the first years is always very low. So you very likely wouldn't be doing that in the beginning years. But later on, when you've had your policy a while, maybe you're nearing your retirement years or you are in your retirement years and your premium might be getting hard to pay or your income has reduced for one reason or another, you do have the option of having your dividend go towards your premium payment, and then you would pay the difference. Or if your dividend is large enough, you could have your dividend cover the entire premium and then send you the difference or send the difference to the policy. So this is an option for the future years of your contract when your dividend has had time to build up and get larger so that it's actually a useful amount to help you cover your premium. A third option of what you could do with your dividends is you could leave it inside the policy and have it buy up additional coverage. That's called paid up additions. And so you let your dividend go and just cycle back into your policy. It will increase your cash value, and then it will also buy up some life insurance. So that life insurance becomes bought and paid for. There's no more mortality fees or charges or anything coming out of that. It buys up a chunk of death benefit and grows your overall death benefit. So that's one of the ways that your policy death benefit is increasing over time, is because you're buying these paid up additions when you have the dividend cycle back in and buy up additional life insurance. And of course, we are also adding a paid up additions rider to the contract, which is buying and paying for a certain amount of life insurance, causing the death benefit to go up and the cash value to go up, just like the dividend does. So if you were to decide, well, I think I just want them to send me my dividend, or in any year you decide, hey, I could use that dividend this year, just send me a check for the dividend, you could make that request and have the dividend sent to you. If you do decide to have your dividend check sent to you, you can only receive it tax-free up to your cost basis, which means your cost basis means the amount you've paid into the contract. So once you've received checks, either dividend checks or just straight withdrawals out of the policy, once you reach your cost basis, anything withdrawn out of the contract after that, whether it's dividends or not, will be taxable. So you want to be cautious what you're pulling out of your contract. Now, the amount of dividends you received is related to the amount of cash value you have in the policy. Sometimes I use this analogy, which is not a perfect analogy, I'll be honest. It's sort of like if you're buying shares of stock of a company, even though you're not buying shares of stock, okay? If you were, it's kind of like buying those shares of stock. And because of that, you're becoming more and more of an owner of that company where you're buying those shares of stock. With a life insurance company, it's like you're becoming more of an owner. The more money you have in there, the more premium you pay, the more cash value you have, the more of an owner you are. So the more the dividend you will receive. Similar to that. It's important too to remember that dividends are not guaranteed. The companies that we work with, they have been awesome though, that we work with companies that have paid a dividend since inception of the company, which is over 130 years, which is terrific, which means that even through the Great Depression, 2001, 2008, they did not miss a dividend, 2020, but they could, any company could miss a dividend because they are not guaranteed. And if the company does really great, then even your dividend rate that you might be expecting, it could go up. If the financial performance and profit of the company has done better than expected, your dividend could go up. You could receive a higher dividend that year or in future years. Once the dividend is earned, it also is captured into your cash value forever. And so now that dividend is going to earn guaranteed interest rate that comes with your contract for the rest of your life. So this is one of the ways that the contract is fueled for growth, because you have these dividends as they're being earned, they're going into the contract, and now those creating a larger snowball inside of your contract, and then all of that money is guaranteed to grow with that guaranteed crediting rate from the insurance company for the rest of your life. However, sometimes clients, they get really hung up on the dividend thing. Those who are seeking information from IBC from all over the place, all kinds of sources, YouTube videos, and all sorts of different people. They're watching different videos and different people. And so they get really hung up on this company might be better or this other company because of the dividend rates. And they're looking at that, or maybe they've been instructed to look at that from some YouTube voice. And so they want to compare companies because of that. But the dividend shouldn't be the reason you're choosing one company over another, because frankly, when you are looking at an illustration, those dividends are projected rates and they could be different in the future. And so sometimes companies are illustrating a rate that's certainly not going to be what they pay in the future, or maybe it will be. We really don't know. And then again, dividends are not guaranteed. They could even miss a dividend. Certainly with all the craziness in the world, it could happen. Instead, I like companies that have strong guarantees, because the guarantee is one of the most important features of the whole life contract. I want my whole life contract and company to be strong. I want my guarantee to be strong, because that is the whole reason why I'm putting my funds into this contract, is for those strong guarantees. I don't want my company taking lots of risks in order to get a higher dividend, or being more risky in general with how they're investing their funds. I don't want that risk. If I want to take risks, I will go to the market for that. Ultimately, the most important thing to look for when you're ready to open a contract is an advisor you like and trust, and someone you want to work with. An advisor you trust and who you know is using a mutual life insurance company for infinite banking style contracts, who is an IBC practitioner with the Nelson Nash Institute. And because many life insurance companies are very strong, it's like trying to choose between Microsoft, Google, and Apple. The insurance companies are strong, good, these mutual companies. So it's really more about the advisors, that you make sure your advisor is trustworthy, that you like them, that you know that you're confident in their knowledge, and that they will plan to be a coach for you going forward, rather than just, here's your contract, see you later. You want someone who's available and who's going to be able to coach you as you go forward, so you can continue being successful with your infinite banking contract. And some companies are actually not IBC friendly at all, which is interesting. And then there's others that really are. For example, my primary company, they actually went out to top infinite banking agencies and asked, what would you like to see? What would you like to see in your contracts? How could we make them better? The actuaries, they went out and asked, what would you like to see? And so they were able to build and construct an awesome product that is actually hard to beat, because they went out and asked us, how could we make this contract better for your clients? And then they delivered. It's a really awesome, it came with a lot of features that are great and a lot of different things you can do, a lot of flexibility. And we appreciate that they were looking out for us and our clients and how they could best design a contract that would be amazing. So just make sure that you like who you're working with, that they are listening to you, that they know their stuff, so that you can be confident that they are looking after your best interests, and that they will be there for you, that they'll be able to coach you through this once you get your contract started. Well, as always, thank you for listening. I hope this was helpful information for you. If you would like my help and you would like to connect to find out how the infinite banking concept could work for you and your family, please reach out to Valerie at alphaomegawealth.com. Until next time, take care.
This is thepodcastfactory.com.